Have you ever wondered why Wall Street is breaking records while your grocery bill is breaking your budget? You see billionaires adding billions to their wealth. You hear about another market rally. You watch financial experts celebrate the boom. And yet, when you check your bank account, nothing feels like it's booming. Your rent keeps climbing. Your savings are shrinking. Your paycheck buys less every month. Small businesses in your neighborhood are shuttering, and every time you fill up your tank or buy groceries, you feel the squeeze. Something doesn't add up, does it? How can Wall Street be partying while Main Street is barely surviving? How can the wealthy be celebrating record gains while ordinary people are losing ground every single day? For decades, we were told that Wall Street's success means everyone's success. A rising tide lifts all boats, they said. But that tide has turned into a tsunami that only lifts the yachts while drowning everyone else. What we're witnessing isn't shared prosperity. It's a hidden money illusion designed to enrich a few while leaving the rest behind. And the truth behind this illusion is darker than you imagine. Stay with me, and I'll show you exactly how this system works. Hit that like button, and let's pull back the curtain. Take a company like Nvidia. A few months ago, this single chip designer was assigned a market value of over $4 trillion. $4 trillion. To put that in perspective, that figure is larger than the entire economy of Japan, greater than the combined value of all U.S. farmland, and bigger than the total capitalization of every firm on the Swiss stock exchange. And what does Nvidia actually make? Microchips. Powerful components, yes, but they don't grow food, they don't put roofs over people's heads, and they don't cure illness. Yet somehow, financial markets insist this company is worth more than entire nations responsible for feeding, housing, and supporting hundreds of millions of people. That alone should tell you something is fundamentally off, and the distortion becomes even clearer when you zoom out. The so-called Magnificent Seven, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and Nvidia, now sit on a combined valuation of around $19 trillion. That exceeds the economic output of Germany, Japan, and India combined. 7 corporations valued above the productive labor of billions of people generating cars, energy, machinery, goods, and essential services. This isn't rational calculation. It's a collective fever dream we've been conditioned to accept as normal. So the question is, how did we drift into this upside-down world? To understand that, we need to rewind the clock and look at the foundation of the system itself. There was a time when money had an anchor, gold. That link acted as a boundary, preventing governments and central banks from expanding the money supply at will. But once that restraint was severed, money slowly morphed from a tangible claim into paper and eventually into digital entries that could be created with a keystroke. From that moment forward, every crisis was met with the same formula. Create more money, push interest rates lower, and hope stability magically returns. The most dramatic example came after the 2008 financial meltdown. The entire system was on life support, and policymakers responded with a monetary experiment called quantitative easing. It sounds technical, but at its core, QE is nothing more than manufacturing money out of thin air, trillions created instantly and funneled to banks, large corporations, and governments. That torrent of liquidity was supposed to revive the real economy, but it didn't. It flowed upward, not outward. It enriched those closest to the monetary spigot, while everyone else waited for help that never arrived. Economists have a name for this structural imbalance, the Cantillon effect. It means the first receivers of new money gain purchasing power before prices adjust. By the time cash reaches the average household, the cost of living has already jumped. So what happens? The wealthy buy assets, stocks, bonds, real estate, and the prices of those assets climb. Meanwhile, the middle and working classes face higher costs for food, housing, energy, and essentials. This pattern has defined the past 15 years, the top soaring to unprecedented wealth, while the majority feels squeezed, anxious, and increasingly left behind. The illusion deepened when interest rates hovered near zero for more than a decade. Think about what that means. Money became essentially free. Corporations could borrow billions at negligible cost. Yet instead of using that cheap capital to build factories, innovate, or raise wages, they engaged in a far more convenient strategy, buying back their own shares. When a company repurchases its stock, the number of shares shrinks, and the price is pushed upward. The business appears wealthier without producing anything new. It's cosmetic prosperity, like repainting a collapsing wall rather than repairing the foundation. This tactic became routine. It's a major reason equity prices skyrocketed even when real economic performance stagnated. Companies weren't generating more value, they were inflating their market image. And throughout this process, central banks applauded themselves for keeping markets stable, never recognizing they were inflating the largest financial bubble in modern history. Look at what we're left with. Markets driven not by productivity, but by liquidity. Prices rising not because of genuine growth, but because of ultra-cheap money, an economy running on speculation instead of work. The stock market no longer reflects economic conditions. It simply measures how much faith investors still place in the prevailing illusion, an illusion built on endless credit, endless optimism, and the belief that the game can continue indefinitely. Professional investors understand this dynamic better than anyone. Surveys consistently show that over 90% of fund managers believe U.S. equities are priced far above their underlying value. And yet, they continue to pour money in. Why? Because the structure of the system leaves them with no viable alternative. When interest rates sit near zero, when holding cash guarantees you nothing, and when the dominant belief is that the game will keep going, even the experts become participants in a cycle they privately distrust. It's not strategy, it's survival inside a bubble. And that bubble has consequences extending well beyond financial charts. As asset prices have skyrocketed, those who already owned assets have seen their wealth multiply at astonishing speed. Meanwhile, people without assets are slipping further behind than at any point in modern history. For millions, home ownership has become a fading dream. Young adults can't accumulate savings. Retirements grow increasingly unstable. Inequality spreads across societies like a widening shadow. This is not a coincidence. It is the predictable outcome of a system where newly created money flows first to those who already possess wealth, reinforcing the gap between the privileged and everyone else. But underneath all of this lies something even more unsettling. The farther financial markets drift from the real economy, the more delicate they become, because they're no longer anchored in production or innovation, but in belief. Belief that central banks will always intervene, belief that governments will always print more, belief that nothing fundamental will ever break. But belief, unlike output or labor, can evaporate in a heartbeat. Before I continue, take a second to hit like and subscribe. It really helps the channel grow. Now back to the discussion. Imagine a sudden shock, a severe debt crisis, geopolitical conflict, or a rapid loss of confidence. The entire tower of inflated valuations could collapse overnight, erasing trillions in paper wealth. People would wake up realizing that much of what they assumed they owned wasn't real in the first place. And that's the core danger. The illusion doesn't merely conceal fragility, it amplifies it. And when it finally breaks, it doesn't unwind gently, it collapses with force. But the most serious threat isn't the crash itself, it's what follows. When people lose confidence, not only in markets, but in money as an institution, the entire framework of society begins to unravel. Our financial system rests on trust. Trust that savings retain value, that prices represent reality, that hard work leads to stability. Once that trust erodes, no authority, not a government, not a central bank, can fully restore it. We're already watching that erosion unfold. People see stock indices hitting records while their own lives grow harder. They hear about GDP expanding, yet struggle to buy groceries. They watch billionaires multiply while their own paychecks shrink in meaning. This widening disconnect fuels anger, resentment, and ultimately instability. Because when financial markets celebrate while ordinary citizens suffer, the illusion becomes impossible to disguise. Think about what this really means. We're watching paper wealth balloon, yet the foundation of real prosperity, production, wages, innovation, barely moves. Numbers on a screen climb higher, but the economy that supports actual living standards remains stagnant. The financial sphere has drifted so far from the real world that the two barely resemble each other anymore. And inside that widening gap sits the great financial illusion, a system where numerical gains are mistaken for progress, where speculation substitutes for creation, and where accumulation is celebrated even as genuine growth fades. What's striking is that this illusion has a natural limit. You can't stretch a false narrative indefinitely. Sooner or later, reality reasserts itself. You can defy economic laws for a time, but not forever, just as gravity eventually pulls back anything built on unstable ground. And the higher a system climbs on fabricated valuations, the more devastating the correction becomes when truth finally returns. So why do markets soar while the broader economy buckles? Because markets today measure liquidity, speculation, and engineered momentum, not true prosperity. The figures are inflated by money printing, by debt, by collective belief, not by productivity, not by value. It is, in many ways, the largest illusion of the modern age. But like any illusion, it survives only as long as people pay attention to it. As long as the public believes the system works, it keeps functioning. As long as investors accept the premise, the game continues. But once people stop believing, once they begin questioning the numbers, the narratives, the celebration, the illusion starts to crumble. And when it fades, it exposes how extraordinarily fragile the entire structure has been from the beginning. No economy can thrive on speculation alone. You cannot manufacture real prosperity by inflating prices. You cannot build lasting wealth on credit expansion and financial engineering. True economic strength comes from producing, from creating goods and services that improve life for everyone, not just enriching shareholders. But somewhere along the way, the world forgot that. And now we're dealing with the consequences. For those outside the asset bubble, the so-called financial miracle feels less like a boom and more like a slow-moving nightmare. At some point, the illusion will break, maybe gradually through inflation that erodes purchasing power, maybe abruptly through a market collapse that reveals the truth. But in every era of financial history, the pattern repeats. The illusion always ends. When that moment finally arrives, people will see clearly what was hidden in plain sight. The soaring numbers, the record highs, the dazzling valuations were never reflections of real value. They were expressions of collective belief. And once that belief evaporates, what remains is the actual economy, strained, over-leveraged, and struggling to breathe. That reckoning is what I call the real reset, not the conspiracy-laden version, but a return to economic truth. When the illusion collapses, what rises in its place is the recognition that genuine prosperity must be earned, not engineered, produced, not inflated. Smash that subscribe and like button. Let me know your thoughts in the comments. And before we wrap up, remember this. I'm not your financial advisor. This video is for educational purposes only, and your results ultimately depend on your own decisions and actions. But the underlying message remains. When financial illusions fall, they leave behind a clearer view of what truly matters: production, stability, and economic structures grounded in real value, not speculation. We'll talk more in the next episode. Until then, stay informed and stay skeptical.